Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is entrepreneur and real estate investment expert, Jim Pfiefer. Now, Jim is the president and CEO of Left Field Investors, a group dedicated to educating and assisting like-minded investors to negotiate the nuances of the passive investing landscape in the world of syndication. Now, Jim is a former financial advisor who became frustrated with the one-path-fits-all approach of the standard financial services industry. Jim now concentrates on investing in real estate assets that produce cash flow and is committed to sharing his knowledge with others who are interested in learning a different way to grow wealth. Now, Jim not only advises and helps people get started in passive real estate syndications, he also invests alongside them in small groups to allow for diversification among multiple investments and syndication sponsors. Now, Jim believes that the most important factor in a successful syndication is finding a sponsor that he knows, likes, and trusts. And so without further ado, I'd like to welcome Jim to the show. Jim, how you doing today?
I'm doing great, Kevin. Thanks for having me on the show.
Excited to have you here. Excited to dive into to your story and learn a little more about yourself and Left Field Investors. And again, I gave you that introduction there, but I'm sure there's more to the story than that. So how about we do this, Jim? How about for those that aren't familiar with you and the background, the story of Left Field Investors, maybe take a few minutes and fill in the blanks for us.
Sure. This is kind of like career number 6 for me. I've done a lot of different things, and I feel like I've finally found what I want to do when I grow up. And, I struggle with my son. He's in high school trying to figure out where to go to college, and he gets frustrated because he doesn't know what he wants to do when he grows up. And I'm like, man, I didn't figure it out until my 50s. But, I worked in business for a while in insurance and reinsurance. And then I was a high school teacher. And then I was a financial advisor. And then I was an active real estate investor. And once I figured out, or I found passive investing in syndications was a path, I jumped all over that because I was a terrible asset manager when I was owning single family rentals, and I had some multifamily. And I was fortunate because at the time I invested at the bottom, and I kind of rode it up and sold, and I made a ton of money, but none of it was because I was doing the right things other than I bought right. I didn't manage it right. They didn't cash flow, nothing. And so what I finally figured out was, it's better to find an asset manager, someone who's good at it, who does it for a living, like you and other operators, and give my money to you and let you do what you do best. And I'll do what I do best, which is hopefully analyze and vet an operator and find the deal. And then I give you my money, and then you manage the asset, because that's what I was not so good at. And so once I figured out that's what I wanted to do, I realized that there's no education around this, right? How do you learn how to do it? It's most of the things you want to invest in are hidden by law, right? You can't advertise these. You can a little bit now, but it's hard to find these investments. And so I started a mastermind, and my intent was to have a dinner club once a month. We get 12 people together, and we just sit down and talk about passive investing in Columbus, Ohio, where I live. And our first meeting was scheduled for March 18th, 2020. And if you can remember back then, that's when the world shut down for COVID. So we never met in person. And that was the best thing that happened to Left Field Investors, at least, because we weren't Left Field Investors then. We didn't have this idea, but we went online, right? We had to meet on Zoom. And so on Zoom, we got some really high profile guests to come teach us, because everyone was sitting at home doing nothing. And so you could call people up and they'd come talk to a group of 10 or 12 people. And so I spent the first year trying to make that group as small as possible. It grew from 10 to 15 to 20 and finally to 50. And I'm like, that's too big. I want it to be a small little mastermind. But we recognized that there's no education out there. People were thirsty for this knowledge. And so eventually we expanded it. Now we're a group of about 1,800 people that are all kind of rowing the boat in the same direction, working towards financial freedom, whatever that means to them. But we've decided to do that through cash flowing real estate and invest in it through real estate syndications. And so Left Field Investors, what we do is we just provide education, a network, and some deal flow to limited partner investors so they can learn how to do this and do it effectively. And we find out it's a great way to make money.
No, that's fantastic. And such a great idea. You bring up a valid point of, this world of syndications. While it's, the world of syndications isn't new. it's it's really seen some rocket fuel in the last decade or so with some changes that we don't need to dive into here in this show. But in any event, it's and as you'd mentioned, there's a lot of depending on what type of what offering it is, there's a lot that never make it out to the general public. Plenty that do, but even then, even for those that make it into the public, it's still like such a minority, right? Like it's just, you don't know where to look. How do you vet these? How do you find a good sponsor from a bad sponsor? What are some of the red flags folks need to be looking for? So would love to maybe dive into that a little bit, and maybe from your firsthand experience. I mean, because ultimately that was the catalyst, right? That was a catalyst to start Left Field Investors, or initially to start that dinner mastermind, because you were kind of exploring this world of syndications and passive investments, and you saw those nuances and you saw those challenges and figured that probably other folks as well, they were having the same challenges, but maybe collectively put your minds together, you guys might be able to share some great information and find some good opportunities together. Now, you've got this huge network, you built this great thing, and are educating others, and the power of a team to identify and locate and uncover more opportunities than one could just do individually. So, but would love to again maybe go back to your original challenges that you faced as you delved into this world of passive investments.
Yeah, I think the first challenge was, right, I was super excited. When you start out, you're super excited, and unfortunately for me, I had a bucket of money as well, right? So I had an old 401k that I'd rolled over, and it was just sitting there, and I knew it had a long time to cook. So I went to a seminar and met some people, and it was through the real estate guys, the syndication seminar. It's a great event, and I went there thinking maybe I'd be a syndicator, and I hadn't fully understood what a bad asset manager I was yet. But as soon as I got there, I realized, oh man, I want to be one of these passives they're talking about. I don't want to be the operator. And so the first mistake I made is I just assumed that everybody there had been vetted and was, top quality operator, and the real estate guys had vetted them. And so I just walked around and I meet people and say, hey, here's some money. I want to invest in your syndication, right? That's how I chose my operators. And, I got into some great deals. I got into some not so great deals too. And I realized that is not the way to pick an operator. And, at Left Field Investors, we believe that the number one thing you need to do that will be the best indicator of your success is pick a quality operator, someone that like, and trust. And here I was just, throwing money out at random people because I didn't know what I was doing. And at the same time, I was so excited to start in this new journey, this passive investing journey, that I committed too much capital to too many of these unknown operators. And so some of those deals turned out okay, and some I'm still trying to get out from under. But that was kind of step one, right? And how do you find a sponsor? And that's how you don't do it that way. I mean, these meetups are great places to meet operators, but that's just it. You meet them, you get to know them, you ask them questions, and then you find out from your community, hey, are these guys legit? And then maybe you invest. You don't do it the way I did it. So that was kind of step one on a 3-step journey to figuring out how to find operators. So if you don't mind, I'll tell you the next thing I did.
Please do.
Yeah. So the next thing I thought, well, I love listening to podcasts. And so I just started listening to every podcast there was on passive investing. And I'd listen to the guests or the hosts and try to evaluate them as an operator. And I thought, okay, if they're on here, they got to know what they're doing. So then I started, okay, I learned more about them because I'm listening to them for 30, 40 an hour, on the podcast. Then I call them up, ask them some questions and kind of evaluate them. And then they send me a deal, and then maybe I ask them a few questions about the deal, and then I invest, right? And so this was way better than my initial approach, right? But at the same time, if you just listen to someone on a podcast, you have no idea if they're just a great marketer, a great operator, or both. And there's no way to really know. And let's be honest, these are illiquid long-term investments, right, that you have no control over. So picking the operator is incredibly important. And here I am trying to figure it out by listening to a podcast, talking to someone for 30 minutes. And then I got to decide, am I going to wire this person 50 grand, right? It's terrifying sending a wire in any circumstance, but with someone like this that you don't know very well, it's just difficult. And then I met, I don't remember where I was, but Steve Sue, he's one of the founders of Left Field Investors now. He and I had a conversation, and, light bulbs were slowly going on. And he said, we mentioned an operator that we'd both invested in. And then we found out we were both in the same deal. And the relief we both felt, I could see it on his face. Like we were both thinking, okay, here's another guy who seems to know what he's talking about, fairly smart. Steve's a doctor, and he did the same thing. He invested in the same thing I did. And it was just such a relief. Oh my gosh, someone else is in it too. Maybe it's not a scam, maybe it's actually a real thing, a real investment. And that confidence helped me realize that the way to pick sponsors and what I do now is I don't invest with a new operator unless they're referred to me by someone in my community who I know, like, and trust, who's already invested with them. Now that doesn't mean nothing's ever going to go wrong, but trust transfers, right? So now I still do the same analysis. I ask all the same questions, but I'm starting from a spot way, way ahead because someone else has already invested with them. They already know that, hey, the wire landed, so it's legit. They already know, hey, I'm getting distributions or not. I'm getting, communications about the deal or not. And it doesn't mean that I don't wait until they've gone full cycle 5 years into a deal, but at least they've been into it 6 months or a year or more, and they know, hey, this is a legit thing. And it just gives you a lot of confidence. So that's kind of my journey in picking sponsors. And I think that's 70, 80% of the battle right there.
I agree. How about meeting in person? I mean, do you ever take the initiative to go either meet at one of the projects or, just find your way to meet the sponsors in person before, as either as part of your vetting process or before you actually wire capital to them? Is that part of the checklist?
It hasn't been, because a lot of this was, the last few years, it's been more difficult with COVID. Now I'm kind of on the web, not the webinar, but the meetup circuit. So I do go to a few of those, and that's where I meet most of the operators. I tell people, look, if you're going to invest $50,000 or $100,000 in a deal, paying $500 to get on a plane and go visit them and see the property and tour it, it's a great idea. I haven't done it very often because, there's just so many other things that get in the way of that. But I think that's a completely valid thing. But I would also counter that that doesn't mean that everything is going to be great. Because one of the deals that I'm struggling with, that I'm having, that, is a problem, is one that I went out, I visited, I spent a full day walking properties, walking everything with the operator, and the deal has gone bad, very bad. And it is the fault of the operator. And so I kind of got snowed by his, he was a great talker, great marketer, acted like he knew what he was doing. And maybe he does. He just has handled this deal very poorly. So while I think that's a great idea, and I would like to go out and visit more often, it can also, in my experience, in the one time that it did backfire, it was, maybe I wouldn't have invested so much, because I invested more with him than I intended to, because of the conversations we had and because of the confidence that I gained, and it was misplaced confidence. So I still rely on the referrals from my community above all else.
No, I agree. I agree with that. I would say that, I'm on both sides of the equation. Obviously, we're syndicators as well, and we're in the capital raising world with Sunrise Capital Investors. But I'm on the other side of the table as well, both of in our own investments, as well as with a litany of other operators. And so I can kind of play both sides of the table. And I will say that the one thing that's been of a huge benefit for me getting comfortable, you can look at a financial model, you can go visit projects themselves. Sometimes you can see through the bullshit of just a stellar marketer, right? Sometimes not. It's just sometimes it's tough to do. And to add some complexities to to an already complex situation, rising tide has lifted all the boats over the past decade, right? And so it's been able to hide and shield a lot of the not so great sponsors. But with that being said, the one thing that I try to do, I'm not going to say I've done it every time on every occasion, because I do use the whole trust factor that you use, right? Like I know other folks that have invested with them. I've followed them for a very long time, looked at the track record, made sure that they've got a stellar track record for many, many years, not just in the last couple of years. Make sure they've got their own capital invested in the deal, make sure they've got a good, strong balance sheet, healthy balance sheet. But outside of that, one thing that has just been critical for me to what I feel is choose great operators is breaking bread with them. Actually not just meeting on site, not just walking a property when there's a couple other investors there. You got a group, and so that dynamic's not as intimate, and it's hard to actually really gauge who a person is, who that sponsor is, unless you can get some true one-on-one time or a very small group, like a setting at like a dinner time. I don't know. I just, I think you just get more of the personal aspect and you get a better gut check. At least I do.
Yeah.
That's worked really well for me. Again, nothing's foolproof, but that's worked
Right.
really, really well for me. Just to get a better sense of who they are as an individual, what's their, forget the investment side of things, like, family life, love to meet like the significant other, like all those elements that kind of play into who an individual is, right? And ultimately who
Yeah.
they are as an individual plays very much into how they're going to operate their company, right? And how they make decisions and their overall, philosophy on life and business, what have you. So anyway,
Yeah.
just putting that out there for the listeners, because again, I'm on both sides of the table. While we do our investments, I also invest passively, personally, and in a litany of other deals as an LP. So
Yeah. And I agree with that. Just real quick to add to
yeah.
that is that when you're sitting down and talking to someone, you're right. When I went to visit the guy, we didn't really have, I guess I got a feeling about him that he was good at what he does, but he isn't the kind of guy I'd want to have a beer with or something. It was just something like, yeah, there were some bells that went off that I probably should have figured out. So I totally agree that getting together in person makes all the difference. And I would also say that I think you have a little bit of an advantage in that you're an operator. So you know in depth more of the questions to ask, the things to look for than a typical LP. So I think it's harder probably for you to get, and I don't think people do it on purpose, but to get snowed over by someone who's just really good at marketing and not as good at operating. But I think, if you connect with someone and get to know them really well, it just makes it so much more comfortable. Right.
Yeah,
And that's probably where it was missing when I did my personal visit. I thought, oh, he knows what he's doing on the business side. The personal side, he's a little bit off, but I'll put up with that because I like the deal so much. Right. And that's where I learned that probably I should have just said, there's something off. Maybe don't go all in.
I think that's a good point, and it's one to hit on. I mean, I think you should always, right? Like you should always want to invest and do business with people that you like. The thing that like caught my attention when what you just said is like, yeah, it seemed like he was really good at business, but like it's not really a guy I didn't really care to have a beer with him, right? Like, and I feel like you should, like, if you like that, maybe to me at least isn't like an internal alarm. Like if I just don't like get the right vibe from somebody, just personally, they might be great, they might be a billionaire, but like if I just don't like them, I'm not going to want to be around them. Like it's just, I'm going to be hard pressed to like, spend my hard earned money and invest it in a deal with them alongside them. And, but I, again, maybe it's a lesson learned, right? That you should definitely want to invest and spend money and invest money with those that you like and trust and like enough to actually go have a beer with.
Yeah.
That should be part of the checklist.
It's right in there, right? Everyone says no, like,
Yeah.
and trust. And I missed the like, right? And that you got to do all three, I think. And
I agree.
That's one of the learning things that I got out of that deal.
So let's talk about maybe some of the, we find ourselves in some, just unique times. I'll leave it at that, right? Lots changing in the world. 10-year treasury has seen all-time highs. All these, the rate hikes that have been taking place over the last year, transactional volume is down, depending on what sector you're looking at, 80, 90%. It's just the landscape is very different today than what it was even just a year ago. And so with all that being said, again, I kind of made a comment of, rising tide has lifted all boats over the last decade. While obviously there's some folks that have lost money, some deals have gone sideways over the last 10 years, many more deals have actually done well. And for the most part, it's not necessarily as a result of great operators. Obviously great operators have done really well, but even not so great operators maybe have been shielded by, again, just double digit rent increases year after year after year, and cap rate compression, and historically low interest rates, all these perfect stormed elements. And so now that we're kind of in a new world, what has changed on your side? Like, have your teachings changed? I mean, how you guys look at deals today? Are they different than maybe what it would have been a year ago or years prior? Again, just any modifications that you've had to make to your overall investment philosophy as you're out there searching for new opportunities.
Yeah, it's been a challenge, right? Because it was easy before, but we didn't know it. We thought we were just really good at investing, and we just picked awesome operators, right? And one of the things, you look at for an operator is you want someone with experience and with a great track record. Okay, well, everybody has that, right? If you don't have a good track record after the last 10 years, then that's an easy, like, you're out, right? Because even I had success as an active investor and I was clueless, right? So it's really complicated because now even some of the, like, there's a particular operator who had a great track record of over 8 years, right? And they had 30% average return on their deals, and they had 5-year business plans and they were turning them around in 2. And you just thought, man, these guys are awesome. And they hit all the marks, and they were great operators, and they've struggled. And there's 2 parts to it, right? One part of their struggle was they were basically flipping apartments. And so they were using adjustable rate debt, bridge loans, which we understood. And the business, that was the business plan, but no one thought that interest rates would go from almost 0 to 5% in a year. And so they got caught behind that. And that really exposed some other weaknesses. It turns out that on some of the properties, like anything they bought in 2021 or 22, I thought, okay, these are going to be in trouble. And it's not really their fault. I was okay with their business plan. I accepted their business plan. I knew what it was. And we got caught because rates went up too fast, right? So on that part, I'm like, okay, I don't know what I could change about that except for say, I shouldn't have done adjustable rate debt, but I also made a lot of money doing that. But the other thing is what it exposed is some of the properties that they bought back in 2019, even they hadn't implemented the business plan. Probably, this is a guess, because they got lazy, because it had gotten so easy to just flip these things without doing much, that now the 2019, the 2020 things that they bought are having problems. And it's really about communication and figuring out, okay, if someone's struggling and there's a capital call or they're pausing distributions, you really got to, as a passive investor, you got to dig in and find out why. Is it because interest rates went up faster than expected and insurance costs have gone up and some of this other stuff that really isn't the fault of the operator? Now, different operators can get through it easier, but if it's the business plan wasn't executed because either they just got too cocky, too lazy, or didn't know what they were doing, that is done. I see you later. I'm not investing with you again if you messed up the business plan, right? But if the other stuff just kind of caught you, well, it caught me too. So I'm not going to, I'm not going to excuse it, but I understand it. So I think it's just, you have to look at the perspective, and it's really hard now to look at people's track records and say, okay, they were great. Now what? Because now you got to look at through the other side. Where are they now? What deals are they struggling with? And how are they handling that? I think that's critical with any operator you're dealing with. If you're going to allocate new capital, is you really got to look at, how did you handle this difficult time? I understand everyone did great in the easy times, but how are you doing now, right now? And it's all about communication, because again, back to this one operator, they came out, I guess last March, and said, hey, we have 2 properties that are struggling. We're going to have capital calls. Here's why. Great communication. Everyone's like, we get it. You had 20 of these properties. 2 of them aren't working out. That's, okay, we understand. And then like 2 months later, well, there's another 3 or 4. A month later, well, there's another couple. And then it's just, you're not being honest and truthful, right? You can make up all the excuses you want, but you had to have known some of those were having struggles. So now more than ever, and one of the key things that we always looked for in sponsors, even back in the good old days, was communication. That's number 1 for me. After you're referred to me by somebody I know, like, and trust, communication, good or bad, you're going to communicate with me regularly. I can email you and ask you questions and you'll answer. It's different than the stock market. I can't email up Tim Cook and say, hey, how are things at Apple, right? Well, I chose to invest like this, so I can email Kevin and say, Kevin, what's going on?
That's
right. So communication. But now it's even more important, because if a deal goes bad and you're communicating to me and you're telling me why, and I understand it, I might invest with you again, because not every deal is going to be great. But if the deal's going bad and you're not responding and you're ghosting me and I have no idea, I am more than done. Like, I'm never investing with you again.
That's right.
Because I'm going to find out at some point when you don't return my money that it went bad, right? Bad news early. Tell me now. Don't wait, because then I'm just going to be more frustrated. So those are some of the things I'm looking at, is communication, and then really trying to understand the past track record, but more importantly, where are you now and what are you doing with the difficult times?
Yeah, no, that's great insight. And the communication obviously the key. And the thing that immediately came to mind, you gave a story of the couple of deals that went bad with the one group, due to debt maturities, right, or adjustable rate debts,
Yes.
or adjustable rate loans. Rates increase. I mean, that was the business plan in the multifamily world, but given that they had a number of assets from that they acquired in 2018-19 that you'd mentioned that they just didn't execute the business plan on. The immediate thing that came to mind is like, they obviously either raised money for those capex items, or they got it funded by the loan. A lot of those bridge loans will fund a certain portion, sometimes all of the capex plan. Just wondering what happened with that money.
Yeah.
Did they never draw on it from the actual loan, or maybe was it never? What did they truly just never raise? A lot of syndicators just over raise and contribute that money to the however many units they're going to renovate. Of the 300 unit complex, we're going to renovate 100 of the legacy units, what have you, over this span of time. But just I'm curious as to what might have happened with that capital.
Yeah.
That was actually meant for the business plan if it didn't get actually implemented. So,
and I don't know. We never heard that because they do these webinars where they group all the properties together and you never really get good information on one. But I think you mentioned something that I'd like to ask you about is the over raise, right? So there's another operator that some people, a few years ago were like, well, no, they're terrible because they over raise and they start distributions immediately after they close the property, and they're basically sending your own money back, right?
Yep.
And that was seen as a horrible thing. And I can see by the look on your face that maybe, you're agreeing with that. But then I want to ask you the other question, and I shouldn't put words in your mouth, but the other end of it is now that operator is solid in the same markets that the previous operator is struggling with because they raised too much. Maybe now they have extra reserves. They can pause the distributions, and their deals they're not in any trouble. They're not doing capital calls on anything. So was it smart to over raise or not? I don't know. I'm curious what you think about that.
Yeah, no, that's a great question. I've never actually heard it proposed in that manner from, now, because no one knew that we would be as deep in this predicament as what we are, right? No one knew how impactful it would be, looking at years back. So like that wasn't part of it wasn't a plan A or plan B, decision on their part when they did the over raise. It was more of a, for the most part, and I'm not saying there's anything wrong with that. I'm not a huge fan of it, because you really are just giving back. Like you're literally giving back, the investor's own capital.
It's like a pre-capital call.
And for the most part, it's only so that you can. It's more for marketing purposes. Is what we don't do it, and so I can't speak firsthand of but I can tell you what I think the reason is for is so that you can, if there's 10 syndications out there, but this one says that they literally start distributions immediately. Because you and I both know a lot of these deals, they were not, for what was being paid, there was no way, there was no cash flow left over to send out distributions until the business plan was executed, until you had a capitalization or a recap event, whether it be a refinance or a sale. Like there just wasn't enough left over. And so it was hey, we got to execute the business plan. So from a marketing perspective, I could see where it was beneficial to where, hey, one thing we do differently from everybody else is we start distributions immediately. While it might only be 4% or 5%, we start immediately. So you start getting cash flow from day one, whereas, it might be delayed 18 or 24 months in these other opportunities. Right. And so from a layman's perspective, I could see the attractive nature of that. However, that has its own inherent risk, right? Being that you basically are putting additional leverage on a deal, and that leverage is literally just coming back. There's nuances with that I never got comfortable with, but I understand the reason for doing it. But I do think for the most part, it was purely from a marketing perspective. And I don't think, again, those individuals that do it, and I know a number of them, and they're good operators. I know a lot of good operators that did that. And just because they're in a good position today and their investments are solid, I think that just is attributed to them being really good asset managers and having their house in order, right? They've got a good team. They actually know what they're doing. And so there's always going to be challenges in a deal. Even in good times, there's challenges, right? And having the right team and having the right systems and processes and knowing how to navigate some of those hurdles, that gets you through the good times and the bad times, right? And so now what you're seeing, I think, with some of these operators that are seeing challenges, they had their ship was not in order, right? Like, and the rising tide lifted their boat, but when the sea started to go out, I mean, their ship's all over the place, rudder's broken, doesn't have oars, the sails are torn, like
Right.
it never really was a good ship to begin with,
Right.
it wasn't fully there. It wasn't fully there. So, but yeah, anyway, back to the point of it. I'm not saying it's a good or bad strategy. I always felt it was mostly from a marketing perspective of why it was done.
Yeah, I agree. It just right now it feels like it's almost like a pre-capital call, right? We gave them a little bit extra capital.
Yeah.
Now they're using it to make sure the asset is in good stead. So I don't mind it as much. It's better than the other option. But you're right. It is for marketing because people in our community, one of the questions they always ask is, when did distribution start? Why don't they start sooner? Right. So that's why companies do this, to market it. Yeah. It just turns out that this might have helped in some of these situations.
Well, because there's so there's a number of, depends on what type of bucket, limited partners, and either they're still in the wealth creation stage of their life, right? So like they need to get some velocity of their capital. They need, like, they're taking their hard-earned money that they have, but they're trying to, like, maybe, they're trying to build upon it, but they're also maybe trying to replace, maybe it's a W-2, job that they have, and they want to, they want to get out of that position at some point in time. And so, like, they need that income. Like, that income is real. It's needed today. Then you got kind of that middle bucket of investor that, they're kind of in between. Like, they've made it, they've done well. They still like that. They like having that passive income. They don't know, they got some investments that are diversified. Some of them don't start producing right away. Some of them do, like, but they're good. Like, they've got their wealth. They've got enough passive investments where they're living their lifestyle and they're doing their thing. They also don't need to recycle the deals as fast. And so maybe they're looking for more longer term deals. They don't have to get in and out of the deal, in 1 to 3 years, like a lot of deals, changed hands over the last couple of years. I mean, they went full cycle in very short stints of time. And you got that other bucket, the last bucket, which is more wealth preservation. Like, they've made it, whatever their net worth might be, they just don't want to lose it now. They don't need to hit home runs anymore. They're actually okay getting, lower returns, so long as the risk is lower. And a lot of them don't even want their capital back as fast because they don't want to have tax events. They're just kind of like, just don't lose it, do well with it. And just, let me live my life. I've already made it. Just don't lose it. Right. Just preserve it for me and my family. But I guess back to that original bucket, like, a lot of folks are in that original bucket. They need that income. Like, they're relying upon it. And so that is a common question that gets asked. And I think it's probably one of the most common questions, like, when did distributions begin? And so that marketing stick is a great way to overcome that objection. It is.
Yeah. And one of the interesting things I think is one of the biggest mistakes I see passive investors make is not understanding where they are. Meaning, if you have a W-2 and you don't need this cash flow, maybe you invest for appreciation. But if you are looking to ditch the W-2, then you need the cash flow. But I see a lot of people finding a deal, they go into a development deal or something like that. And you got to understand that the goals you have to match your investments to those goals. Right. And that sounds like, well, duh, of course you do. But, most people, or a lot of people, when they get started, they mess up on that because they're not really thinking of, and I did the same thing. The first few deals I got in, I was trying to, get cash flow, but I saw these deals that were like apartment flips. I'm like, those are awesome. I'm going to go for those. And a lot of them worked out, but they weren't cash flow. And what I needed was cash flow. When I finally figured that out, I'm like, oh, hold on, I'm a full-time passive investor. I got to do cash flow. And so it's just a mistake people make it when they first get into it and they're really excited about starting.
And I think a lot of times some of the mistake also revolves around they get sucked into the metrics that are being marketed. So speaking to, like, the development deal, right? Like, there's going to be a number of years where there's no cash flow whatsoever. Obviously, the IRRs that are being projected are significantly higher, but also along with that comes a lot of more risk, right? Just given the time and the inherent risk that comes with development. And then the equity multiple typically is a lot higher as well. But again, what comes along with that is delayed gratification and a lot of risk in between the time that the project starts to when it's actually at completion stage. And so, but I think a lot of folks they purely look, they scan offering memorandums or opportunities, and they get sucked into the IRR or the average annual return, or maybe the historical average annual returns, right? And I've been seeing a
Yeah.
lot of that marketed over the last year. Obviously, there was just absolutely some home runs over the last just decade in general, but more specifically, between like 18 and 22. I mean, you could sneeze and get a 30%, annualized return. If you were in the multifamily space and you're a part of one of those deals that was getting recycled every 1 to 2 years, right? Cap rate compression.
Yeah.
I mean, just double digit rent increases year over year for a couple of years. It's just, you didn't have to know much to make money. And so again, but I think a lot of new investors, they get sucked into those metrics and don't actually understand how those metrics are defined, and also how that plays and what is the best strategy, what should even be important to them based on their own personal goals. And do they know what their own personal goals are, right? What are they
Right.
looking to achieve? Because there's so many different ways to get there. And so I think like kind of backing up and starting from the baseline of like, what are you looking to do? Like, what is your overall objective in the next year, 5 years? What is it, just to quit your W-2 job? Is it to, multiply your wealth, 3x over the next 5 years? Do you need cash flow today? Do you not need cash flow today? Like there's all these questions that you have to ask yourself in order for you to define your own plan. Once you have that defined, it's going to make it a little bit easier to identify the right investments that help you, match your goal. So, but even then, it's
Yeah.
still challenging, especially
Well,
when
it
you got
is.
some amazing marketers out there doing their thing. Anyway, just there's some misleading information out there as well. And so it's hard to navigate this, but that's the reason why you guys are here, right? That's
Right.
literally the reason why your organization was created. And I mean, that's what you guys do. I mean, like your sole, one of your sole purposes is to help investors navigate these nuances that we're talking to. And so especially new investors that are just, I mean, drowning in a sea of syndications because there's a
Yeah.
lot of offerings out there.
And that's part of the challenge, right? Once you pick your goal and you say, "How I'm going to be a cash flow investor," you can't just go. I mean, you got to wait for a deal to cross your desk that actually meets that. And
Yeah.
on the way, there's going to be 4 deals that come across your desk that just look super awesome and fun and, returns through the roof, but they don't match your goals. And so then you have to learn how to be like, I'm going to wait. I'm going to wait for the next one that comes from an operator I know, like, and trust, that has a deal that matches my goals and strategies. And it's difficult. And that is where, I tell people, if you're going to be successful in passive investing as an LP in syndications, you got to join a community. It doesn't have to be left field investors. There's other fabulous communities out there. Of course, I'm biased. I think ours is the best, but there's other really good ones too. And you got to find a community where the culture of that community matches your personality.
Mm-hmm.
But I don't see how you can be successful unless, if you're just going on your own and you don't have a network that can help you, or, a community that can help you, because as we talked about, these are long-term illiquid investments out of your control. And it's hard to find them. It's, alternatives are a scary investment area. It's not like traditional where you can just, put it in the stock market and take it out whenever you want. So
Right.
I think a community is super important.
Yeah, no, I agree with that. And so I would love to know, like, what are you seeing now? Like, what's coming across the desk at Left Field Investors? I mean, and how does that differ from maybe what was coming across the desk a year ago or maybe a year and a half ago? Just would love to, get a sense of where we're at in things. I mean, are you seeing like a third of maybe the opportunities coming across the desk, or less than that? If so, and then what are they? Are they, they development deals? Are they your traditional syndications? Because again, I've seen some rescue funds out there that have popped out of the woodwork. And so just curious as to what you guys are seeing.
Yeah, I think it's interesting because I think we're seeing fewer deals per operator, but a lot more operators, because it's harder to raise capital now than it was a year ago, as I'm sure you know. And so a lot of LPs are patient. They're not investing as much or as often. And so what we're seeing is, the operators we typically are, that are well known in our community, they don't have as many deals. And so that gives the opportunity for other operators that we haven't heard of before, that are having the deals. Or what it also seems to be is a lot of the operators that we used to do single asset syndications are now doing funds. So instead of investing in one deal, you're going to invest in a bunch. So instead of seeing this operator every month with a new deal, you're seeing them every 9 months with a new fund, or every year with a new fund, or whatever the pace is. So I think that is one of the things. Is I think most of the LPs in our community are seeing about the same amount of deals, but instead of, from the same 12 operators, it's a bunch of new operators and some of the old ones. So I think it's harder to sift out and harder to jump in all in with one. But I also think people now have seen some of these companies that maybe didn't execute like we thought they would based on the experience and their track record. And so people are also trying to diversify more. We've always said at Left Field Investors, we diversify by asset class, by operator, and by market. And I think people are taking the diversify by operator more seriously because you don't want to go all in with just one unless you're super, super sure. And there's a few operators that people feel like that. So maybe they're doing a little bit more with them, but less with all the rest, and just kind of really diversifying. We also use a company called TribeVest to do group investing. And we see this a lot where instead of investing, maybe the minimum's 50 grand. Well, if you invest with 5 other people, then you can get in a deal for 10 grand. And instead of getting your 50 grand in one deal, you can get 50 grand in 5 different deals. And of course it mutes your returns on the upside, but it really protects you on the downside. So now you're in 5 different deals, maybe 3 asset classes, 4 different sponsors. And so I think there's more of a thought of community type investing. We're also, I think there's more focus on debt, where I think people are looking at it like there's less risk in debt than in equity. So we're seeing a lot of people looking for debt, but also debt that they can get in and out of that pays, high returns. Everyone's looking for the holy grail of 12% returns where you can get your money out in 6 weeks, right? And that we haven't found that. I'll let you know when we do. But there are some where you can get a little bit better returns and you have some liquidity. But then there's the talk about, do you really have liquidity? Because some of us have gotten into some of those funds where something happens, I don't know, a pandemic, and all of a sudden you can't get your money out. So you have to be pretty cautious of that. And I'll tell you one thing that I've kind of changed up on. We talk about left field as alternatives and right field as the stock market in our little lingo. And, for a long time, I was a financial advisor, so I was all in on the market. Then I found, real estate, and then I went all the way to that side. And now I'm realizing that, the stock market is a tough place to be. I believe it's speculation, not investing, but it's also not a bad place maybe to park some money for liquidity. And so, my thoughts are ever evolving on that. So that was a lot of different things. I'm not sure if I've answered the question.
And I think it's having a balanced approach, right? Like I think that's to summarize your last point there, it's just to have a balanced approach. Like there's not one size fits all that's going to get you to that, to that holy grail. So I am surprised to hear that you're seeing a lot of new syndicators out there. I would think that of all times, like now is probably the right time for new syndicators that are maybe just getting their start or don't have a track record to be trying to raise capital for a deal or anyway. But that's interesting. And I have seen a lot of debt funds. I've seen.
Sorry, if I can interrupt real quick. When I said new, I meant more new to our community where people are reaching out more. We haven't seen a whole lot of new syndicators, but ones that we haven't heard of before that are now maybe doing a little bit more marketing than they used to do and really reaching out more than they used to do because capital is so hard to find. And so that's the challenge rather than just new to the business.
Understood. And, Jim, switching gears here, I don't want to run out of time. I want to give you the opportunity to talk about some of the other things you have going on. I know that you guys have a lot of educational resources on your website. You guys host webinars, different types of events. You have a podcast that you've been hosting now for a number of years. But also I know that you've got an event coming up and you guys are doing a kind of a partnership with the Best Ever Conference, Joe Fairless. I believe it's next year. Is it February that they're hosting that?
It's April, actually. Yep.
It's April. Okay. Why don't you go ahead and feel free to share a little bit of info about what you're doing there with Joe and his team and anything else as far as, where folks can learn more about you, your team and everything that you offer there at Left Field Investors.
Oh yeah. Thank you. So we're super excited. We've had 2 meetups that we've done in Columbus, Ohio, where we're semi-based. And we just got done with our 2023 version. And we announced there that our next meetup is going to be in Salt Lake City on April 9th as part of the Best Ever Conference. And we went to the Best Ever Conference last year and met a ton of great operators, a ton of great LPs, and just had a fantastic experience. And this year they invited us to do an event that is going to concentrate solely on educating limited partner investors. So April 9th, the day before the rest of the BEC starts, we are going to host just a full day of education from 9 to 4. just really talking about how you can become an expert limited partner investor, all the things you need to look at, how to evaluate a sponsor, how to analyze a deal, how to set your goals so that the actual investments you're doing are matching the goals that you have. So we're super excited about. We're really thankful to the BEC for allowing us to have this opportunity, because as I said, it's a great conference and we're just going to be, one day of it. So we're super excited about that. We do have our podcast, Passive Investing from Left Field. So you can check that out. And then our website, leftfieldinvestors.com. We have a couple different membership levels. We have a forum where people are always talking about passive investing. So if you're really into passive investing and you want to find a community that can support your addiction to making money from syndications, then I think Left Field Investors is the place to go. If you have questions for me, my email address is jim@leftfieldinvestors.com. I'm happy to chat. But, in the end, again, as I said before, it doesn't have to be Left Field Investors, but if you're an LP and you realize that, it's better together working with a team, find a community. There's a lot out there, and it's just, man, it just makes you become a better investor. Absolutely.
Yeah. Well said, my friend. Well, Jim, it's been a pleasure having you on here. It was a long time coming, but glad we got you here, and appreciate you coming on here and sharing all of your valuable insights, and wishing you and the team over there at Left Field all the best. And hopefully look forward to meeting you in person at the Best Ever Conference next year.
Awesome, Kevin. Thanks for having me. Appreciate it.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.